buy their Porsches. You want you to do everything to keep feeding them and paying their bills. I'm looking to end your visibility, but not your viewership. That's my goal. I want you to say, you know what? I learned enough. Thank you, ICP.
All right. Can you hear me? Hello, hello. All right, perfect. All right, so this this here is a fair value gap. What defines a fair value gap is the low of the previous candle and then the high of the candle after a large displacement candle. So let me get this out the way. So when I see, oops, so when I see this large displacement like this, that I like to indicate from the bottom of this candle to the top of the next candle that there is the gap. So everything in between here is considered an inefficiency, and price, once it runs away from that, price likes to return back into that to fill in that gap. So one or two things can happen at a fair value gap. So I notate them depending on other uh, price action moves. I will just sometimes I'll enter at the 50% depending on previous price action move, but most of the times I'll just watch that fair value gap to see what type of action we get off of it. Because depending on if we're bearish or bullish for the day or for that session, the fair value gap can get ran to, and it can act as support. I mean, not support. It can act as resistance to where the price will get to it, and then it'll reject it and resist it and push it down lower. Or price can get to it, it'll run up above it, come back down, and then it'll start acting as support. Meaning it'll come back down and then run up to a higher inefficiency or some liquidity, as I have marked up here. This is a good spot that price could potentially come to at the 9:30 opening. I have these green lines on here uh, marked up because this one is the 9:30 New York Open. This is when equities open, so this is when the volatility usually comes into the market. 10 o'clock. What the fuck is that? Oh. From 10 o'clock to 11 o'clock, that is the time window that I would trade if I don't catch a trade from 9:30 to 10. So hold on 1 minute. Okay. So I like to annotate those time frames in that window just so have a viewpoint. Oh, shit. Wait a minute. I don't know how to do this. Hello, hello. Hold on. Give me 1 minute here. I don't even know if I can stream both services. It'd be nice. I don't know if my computer have the bandwidth for that because I'm streaming on YouTube as well right now. So if it gets choppy, let me know. But let me see if it's even gonna let me share it. Give me a minute. I'm really putting my laptop to the test right now. That's for sure. All right, you see my screen? Yes. All right, that's good. That's good. I was just going over a preliminary trade setup, pre-market real quick on YouTube. But yeah, go ahead and send them the link. Go ahead and share it, and then we're going on. All right, but so far, what I was going over right here, see, I have buy side liquidity, I have sell side liquidity marked up. I have this fair value gap marked up, and as you see, it could potentially tap the 50% of this and not go above the high of this candlestick here, and that would validate this fair value gap as a place of resistance. But seeing that it went above it, I would expect price to come above here before starting to reverse or do anything else. So I just like to annotate these just to use it as a reference point for either support or resistance. Seeing that it broke above it, I would now use this area as an area of support. So all fair value gaps aren't just automatic entry points. There have to be some type of narrative or storyline before price action created the fair value gap in order to just automatically enter on the 50% of that fair value gap. Um, did you see that trade? Um, did you put that trade back on your chart? The one where I showed you how to assimilate the trade? This one? Yeah, the one that was on Friday the 18th. Remember we set the limits on there? Did you did you get entered on that trade? Oh, okay, okay. I thought you put it back on. Because I left the limits on and that trade played out overnight. So it entered over here during the Asian session. And as you see, it went to take profit during London session. So that was a winning trade. Okay. Yeah. Okay. Perfect. Is it laggy? All right. I got to get a little more memory on my computer right now. So bear with me for now. But okay. So this line here, I have that annotated as buy side liquidity. I have this annotated as sell side liquidity, and I have those marked up because those are the most recent highs and lows previous to the 9:30 New York opening. So those will be potential targets or areas of liquidity that I would expect the market to draw to during the 9:30 and 10 o'clock window. So having these marked up, I would expect one or the other to be ran. And once one of those is ran, I would look for indications of either a continuation beyond that to another relevant price point, like these multiple relative equal highs up here could be another potential area. Also, this is the London, the highs of the London session, so that's also another area where it can come to. And then this part here, this is where we go to regular trading hours. This line here is where price closed on Friday. So when price closed on Friday and then open up on Monday, where this opens, that's going to be a gap. So these concepts are based on teachings by ICT, Inner Circle Trader, and he says that there's a 70% likelihood that that gap will fill in 50%. So having that understanding of price action, I'll annotate the opening price of the 9:30 Monday New York open session, and then already have that annotated, and then I can draw a fib on there to get the 50% mark of that area. And getting that, I can expect to be bullish for the 9:30 a.m. session, and that will also align with taking out buy side liquidity here and buy side liquidity here. So I'll have multiple confluence for a bullish bias for this 9:30 open window, meaning I will cancel out looking for any sales. Also, the fact that we're above this 1 minute fair value gap, which could have acted as resistance, meaning price could have came up to it and completely rejected off of it. And had that happened, I would have been looking for price to come down under sell side liquidity. But the fact that we're above this, I would use this as support. So I just like to mark things up, annotate them, and just use them as like points in price action to where I can just use it for information, use it for relevance, and use it for confluence for my bias or for a trade that I'm getting ready to take. So here, what I'll look for, the first fair value gap after the 9:30 New York opening, if that's a bullish gap, I will execute on 50% of that gap and ride that higher. So, and if we were to get a bearish one and we get a candlestick to close under this 1 minute fair value gap, I would use this fair value gap as resistance and use the fair value gap, the first one after the 9:30. I would use that as an entry point to ride price down under sell side liquidity. So it's it really can go either way, and that's why I don't execute before 9:30, because price can do anything at 9:30 opening, and it can do it very fast. So let's go ahead and observe and see what price feels like delivering today. Yes, it's a Nasdaq 100. Um, yes, this market has a lot of volatility. Okay, we just took out the buy side. So depending how this candlestick closed, if it closed with a body above it, I would expect price to continue to run up here. If it closed with just a wick, then that could have just been a liquidity grab and it's grabbing the stop losses or the buy stops that's above here. And then it could reverse down and grab the sell side liquidity. So I'll sit here and just take note of how this candlestick closed because that will tell the story of the price section. Each candlestick when they print, they're leaving clues basically. So that's a large up range bullish candlestick. The body closed above this buy side liquidity. So that's an indication that we want to go ahead and continue up. Now, I will wait for the first fair value gap after 930. The 930 fair value gap, can't use that one. No, shouldn't note that one because that could just be the manipulation move. And you see here, we wicked these highs, the London highs, right? So if this maintains just a wick, price could completely reverse from here and seek sell side liquidity. And this leg up could have been a manipulation leg. So using this fair value gap here, you could get, you know, you could get tricked into getting into a buy when it really was just a liquidity grab above London. So always wait for the first fair value gap after 930, just to be on the safe side. See how it completely filled in that. So using the logic that I teach, if we would have entered on this supposed fair value gap and placed a stop loss under this candle, we would have been stopped out right there. So that would have already been a trade. So that's why I would like for this candlestick right here to close under this low with a lot of volatility. If we close under there and leave a strong and close under it with the body and not just a wick, then the next candle open and push down, that would be the nice fair value gap. But that's not going to be the candlestick to do it right now. It's like just wait, see what price wants to show us. So these large wicks, the wicks do the damage, the bodies tell the story. So in order for me to feel comfortable taking the trade for um, shorts, price will have to close under this 1 minute fair value gap. If I see that with a new fair value gap in this area, I will feel confident with taking a short down under these lows, considering we've already ran out buy side liquidity here and also took out London's highs. So I would feel comfortable taking the short and writing it down here, but I would need some type of confirmation at this 1 minute fair value gap because this right here, as of now, could be acting as or is acting as support. So I would need it to break that support and have this turn to resistance before even thinking about taking a trade. And today, wouldn't really be expecting a large range day, basically because um, there's no like large impact news that's coming out on the economic calendar. So whenever there's no high impact news, like you don't really expect a lot of price action. So you just ICT says to note out the previous range or session highs and lows, and potentially the previous day high and lows, and look at those as potential targets, but don't expect a large range in either direction. You know, like these are tradable days, but just have your expectations pretty low. And there's a high possibility that on these days the market could just go sideways. You know, it can consolidate for some time, and those conditions are usually damaging if you don't know what you're doing. All right, so if it break this high and then leave a body above it, then this is still going to be bullish. And this fair value gap right here, if it leaves this open, would be one that I'll enter in for a long. So that's what I would look for, or those things will have to align in order for me to take this long. I would mark this up as such because this is would be the first fair value gap if this candlestick closed bullish. And my trade would look something like this. Be at the 50%, stop loss below the candlestick that left the fair value gap. Because if this gap is valid, price should not come under the flow at all. And then I risk to reward. What was that? My risk, yes. Both bullish above that. So we have a market structure shift or a breaker structure here. I'll go ahead and annotate that real quick also. We have a lot of lines on here, so let me make that one a little bigger. I normally keep the minimum amount of stuff on here just so I can see price action clear. But just for this example, I'm gonna go to mark it up so it'll be easier for you to see. Okay, so this would be my projection. This down here is my risk, right up under this low. So I'm expecting to have a reward of 3 times the amount that I'm risking. So let me hurry up and enter this before price comes down. Now this is just a demo account, just to give. Yes, I'm gonna buy at the 50% level of this fair value gap because um I have a couple of different things aligning to bullishness right now. So put my stop loss here, take profit, be here. I'll hit buy, and that will be my 9:30 to 10 o'clock morning trade. Now, if this trade plays out, goes my way, I'm done for the day. I'm not concerned with the rest of the price section. I will come back towards the end of the day and analyze it and see what happened, but I wouldn't want to spend time in front of the price section right now because I want to continue to live my life and just go on about my day. So I would prefer to get this early morning 9:30 to 10 o'clock trade out the way. But if not, if I lose this trade, then I'll sit on my hands until after 10 o'clock. I won't push the button again within this time frame. I'll just let the rest of the price action play out, and I'll wait until after 10 o'clock and look for another setup during that window. And then if that trade don't play out, I'm done, completely done for the day. It's my 2 losses for the day. I get a win in either one of those. That's my trade for the day. So here I would expect price to come down to 50% of this. It don't have to do that. It don't always do it. Sometimes it'll come down and just tap the top of the fair value gap and then run up, and I'm all right with that also. A missed trade is better than a losing trade. But that's just what I would expect it to come down and do. And also, it looks like it's respecting this fair value gap here, which is the fair value gap that broke the structure. So that would be the more viable one, but there's a little more risk that will be involved with that trade because there's a fair value gap under it. So price can potentially come down here. So I wouldn't want to have that amount of risk on my trade. So I'll be okay with this fair value gap getting tapped and it takes off versus me getting in here, having my stop loss here, or having it down here because it is fair value gap, and then be open to all of this extra unnecessary risk. So I would rather miss this trade and then look for another trade after 10 versus take a larger loss than I have to on this, trying to get in on this first fair value gap, you know? Because it is showing that it's respecting this. And now I just tap the high. Yeah, it's trying to reach. Uh-huh. Yes, just yes, that's all it needs. Just price needs to come to that price point. It can be for a split second. Just as long as it tap that, it'll automatically enter the trade without any more input from me. So I can walk away from the computer right now. I can close the charts, and this trade will still be active without any input from me. But the fact that these bodies are staying inside of this fair value gap, it's showing respect for that fair value gap. The wick came under it, and the wick came down and did the damage. Let me get this out the way. You see, the wick came down and did the damage, but look where the bodies are staying. The bodies are perfectly respecting this fair value gap. So that right there could have been potentially a missed trade. It's probably going to go ahead and run up here now. Grab the liquidity under this candle, barely wicked under it. And now, the 50% of this wick could act as support. ICT calls that consequent encroachment. So sometimes I will mark this up using a fib. I normally use this on a higher time frame, but it can be relevant on the lower also. So 50% of that could act as support in this instance. See how close it came? Or I told you sometimes it can tap just the top and reverse from it. That's usually expected when you have a fair value gap above it. And but like I said, I wouldn't have wanted to be open to all of this extra risk, especially with, for one, this is a Monday and this is the first trade, so there's more opportunities within my trading session. So I don't have to force a trade. You know, I don't have to put myself in situations where I'm uncomfortable with the risk. So I would be completely content with this trade playing out. If anything, it gives me more confidence that, you know, being able to read price action the way I'm reading it, that the bias on everything that I use as information to give me the bias was on par with what I thought it was basically. So it just built my confidence that I had the direction correct. Although the entry wasn't all the way, correct, but this aligns with my logic and with my strategy. So as long as all rules are followed within that logic, to me that's a W, you know. And this here, this down close candle is acted. This is considered like a bullish order block. So viewing this, I would view this as a confluence to the bias as well. So seeing price come down here and it taps into a fair value gap and it aligns with this bullish order block, that's giving more reason for the price to push up. So in order for this to turn bearish, I would need this fair value gap to be violated and this order block to be violated and also this fair value gap in order for me to get into a short, expecting price to go below sell side liquidity, because this is still would be a target for today, just maybe not right now during the 9:30 to 10 o'clock session. But let's say we during 9:30 we ran above Asia's high and ran above yesterday's, or what is this, Friday's Friday's lunch session, and we came into this area of inefficiencies. I would expect price at that point, it has done the damage to the upside. Now it wants to go ahead and come down here and seek the sell side liquidity. And that's what I would expect in between the 10 o'clock and 11 o'clock window. And um, I will look for my model to set up there, which is the breaker structure with volatility or displacement, and then a fair value gap. And I will enter on 50% of that and write it down. You see this wick here in this down close candle? It took out the liquidity under here. Zoom in a little bit. See it barely wicked under that candle. Yeah, it's pushing up. So right now it's just trying to knock people out that is trailing their stop loss. So as price is moving up here, there's people that could have bought in here, and then they'll move their stop loss limit to this low while price is way up here. So the algorithm will come down, seek that, knock them out of the trade, and then continue on up to the target. You see that right there would have been a winning trade had I got in at the top of that fair value gap. That trade would have been done for the day. I would have closed my charts and went about my day like nothing happened. Now this still could be a viable trade. The fact that we came up here and took out this buy side liquidity, there's sell side liquidity this low that the market could come down and seek. And this fair value gap, this bullish order block can act as support to keep price above my stop loss. So this potentially could still be a decent trade. So I would keep this limit order in until one or two things, either until a higher target has been reached, or until of course price come all the way down and stop me out, or until like it gets well past 11 and it just continues to go up and it's past 11 o'clock, then I'll go ahead and close this limit out and go about my day. But I wouldn't leave it home and just go throughout the day if price action is well above my entry point. See, price is leaving a lot of wicks. Normally on days that have like large impact news, you won't see a lot of wicks. You'll see large bodies closing or down. Yeah. So it'll be a lot of momentum like these candles here. But seeing these wicks, that's usually manipulation, you know. Like there's a lot of price movement, but there's not a lot of traction, like a lot of distance on those moves. They just move in a small range, but real fast, basically. Just seeking liquidity. So these are not the favorable days to trade on. These are the days that will have you pulling your hair out. So now seeing that it's hanging around this high, showing some weakness after grabbing this buy side liquidity, I could, if I wanted to trade this to the downside, I would wait for a small um I would have to wait for a break under here. And if this guy right here left a this candlestick that broke this low left a fair value gap, I could enter on that for a quick little short or quick little scalp, but I wouldn't trade that right now. But that's just something that I would look for, and I would expect price to push down up under this little sell solid. Consequent encroachment. That's the just the 50% of this wick. Usually, when there's a there's a wick that's left at the high or the low, 50% of that could act as support or resistance. As we've seen here, price came down, took out the sell side liquidity below this one, but it stayed above the 50% of this. So that just validates this low as being the low for this price movement. Okay, let's see what price is seeking here. All right, so now we have the highs above the Asia session, and also this here was the Monday's closing price. So remember that gap that I showed you that we had on regular trading hours? Because this is where price closed on Friday, my bad. Friday's closing price was there, and then today's opening price was down here. So from down here to up here, that was a gap that the regular trading hours there was essentially no trading, but the electronic trading hours, all of this price action happened overnight or over the weekend. But well, not the weekend, but essentially over the off peak hours. So when we have a opening price lower than Friday's or the previous day's closing price, we can expect the bias for that morning session to be bullish. So that's why I was looking for buys during this session before 9:30 opened up, because I already had annotated this price point. So now that we've reached that target, it would I wouldn't continue to have this trade on here after this higher target has been reached, because the damage is already done up here, and it happened in this window. So now we're gonna start a new macro, which is after 10 o'clock, and I would expect for price to typically reverse from there, because usually between 9:30 and 10 o'clock, the market will create a high or a low within that time frame, and once that high or low is created, the reversal for the rest of that trading session can happen between 10 and 11. So I wouldn't leave this limit on. I would get rid of that, wait till after 10, and find a new trade over here. Because this line here was a target for the morning session. I just missed the entry. Trying to be super precise, but this is following the logic. So that's, like I said, that's a W on my books. So seeing this here, I would like actually I like to drop down to the 15-second chart to get a little bit more information. So we have breaker structures here. We have this fair value gap. So that right there would be an area that I would look at and expect price to react off of it. You see here, this one came up, acting, fair value gap is acting as resistance now. We have another breaker structure here. So if we have a fair value gap on this candlestick, that could be another area of interest. And this is the 15 seconds, so price is moving real fast. Now, this high is within the 9:30 to 10 o'clock session. So at 10 o'clock, if I'm expecting lower prices, I would expect at 10 o'clock for price to come and wick above here on the 1 minute candlestick, and then start showing signs of it seeking lower prices. Before I enter on a trade, I would need to see displacement away from this area. I don't want to see it hanging out around here, consolidating, going sideways. I would sit on my hands and just patiently wait through all of that price action until I see a large candle like this print to the downside while breaking a low. Once I see that, that's a candlestick that will have my interest, and I would execute on that candlestick, 50% of it. I like to mark these up because when I'm bouncing around from time frame to time frame, you want to have your fair value gaps notated so you have a reference as far as exactly what time frame it's on. Because if you look here on 15-second time frame, you go to the minute time frame, you don't see a fair value gap. There's a wick there, and there's a wick down here, small baby fair value gap right there. But this is annotating something larger than that. So it's good to know exactly what that box is representing. See how it was acting as resistance, and then now it's going to turn support if this candlestick closes above it. That's another. I like to mark these up just to see how price action reacts, or how it behaves around those areas. Because it will tell you a story. Now it's after 10. So it looked like it wants to seek the liquidity above here. Now I could grab this liquidity, run up and retrace down a little bit and then continue up. Or it can grab the liquidity and start giving me indication that it wants to go lower. And like I said, once I get that signal, even if I get a signal of displacement on a 15-second chart, I still wouldn't use that. I would go to the minute chart and wait for displacement on that candle, which would give me even more confirmation. So again, even though I missed a trade here, I'm still not super eager to take a trade in this window to where I'll, incur or expose myself to more risk by taking a low probability trade because there's not multiple things aligned that's pointing in my direction. But seeing stuff like this, seeing price break back down under this fair value gap after this liquidity over here was taken, if price stays under this fair value gap, that's indication that price wants to be a little heavy and push towards the downside. So if I was to have a large displacement candle push under here, I would feel confident with taking the trade, but it'll have to be on a 1 minute chart. It'd be nice to see it grab this liquidity and then give some type of sign that it wants to push lower for me to take it lower. If not, if it leaves a strong candle close above here on the 1 minute, then I'll look for a buy. And my target would be, let's see here. Drop down to the 1 minute. Get rid of this real quick. Anything in here will be my target. Okay, so if this close above here with this body, and then next candle close and runs up a little bit, and it don't fill in this void, I will enter on this void. But if this come down here and immediately close this in, then that's not leaving a fair value gap. So I was waiting until the first gap. Okay, I left a little baby one. If this one closed up here somewhere, all right, well, I'll close that in. So that's not valid. So you have to wait until the next candle close. Here we go, testing that 15-second fair value gap again. tap this bullish order block right here and completely reverse from it. So now I will wait for a fair value gap after this high has been broken to enter on. So this right here is the Asia sessions highs back here. So there's liquidity up there. We just grabbed. For it to continue bullish, I would like this candlestick to close above here and not just leave a wick above it. And then I will feel comfortable with taking a buy up to here. So we have a bullish order block here, and we have a small fair value gap here. And actually, there's a volume imbalance. So that's three things that I have where price can come back down to and bounce off of. So this right here would be considered a high probable trade. So we have the top of that, and then we have the volume imbalance plus the fair value gap. So the trade will look something like this. 50% of that gap. Stop loss right below the candlestick that left the fair value gap, and then 3-1. And that ends up right below the 50% of the fair value gap. That was during, I believe, Friday's London session. No, not Fridays. It was Thursdays. Thursdays fair value gap. So this would be my trade for the 10 o'clock to 11 o'clock window. If this trade plays out, done for the day. If this put me in and stop me out, I'm done for the day. That'll be 2 losses for the day, and that's all the amount of damage I allow for my accounts. That actually left a big gap right here. But knowing how a price responds to the volume imbalances, I would still feel comfortable leaving it down here versus up here. Because the thing with volume imbalances that I've noticed is that when the candlestick, the first candlestick that's involved with the fair value gap, when there's a volume imbalance on it, price can come all the way back down um, to this low or just above it. So this low wouldn't be a good spot for your stop loss if I was to mark it up like this. If I was to ignore the volume imbalance and put my box here and put my entry at the 50%, the stop loss below this low, that right there would not be a safe trade. I would not trust that with a volume imbalance been there. So when the volume imbalance is there, you must use the low under the candlestick that left the volume imbalance. So you see, this is a higher entry, but look how much more risk would be on the table. And then using the logic of 3-1, look how much higher the trade would have to travel in order to hit your target. So the likelihood of this trade playing out versus this one is you have greater chances with this one, you know. Although there's a possibility that price can come down and not tap you in all the way down here, but it's still less risk if you do get tapped in here with this being stop loss versus this being your entry and then your stop loss being all the way down here. So again, I'm not pressed or I'm not eager to get into a trade to where I'm opening myself up to more risk. All right, let's see what price wants to do. Let's see what it look like on the 15-second real quick. Let's get a little more information. We got some displacement here. Took out this little sell side liquidity and also broke the structure. Left a little baby fair value gap right here. Price came to it, it's respecting it. So let's see if he wants to go ahead and push down and break this with some displacement. The fact that it went above this candlestick, that it usually invalidates this fair value gap, because that's where I would like to place the stop loss. Some people place the stop loss above the recent high, but I don't feel comfortable opening up to that much risk. Okay, just to show. Okay, well I'll go ahead and get in on using this fair value gap for a short. So I would just, if I want to enter on a market limit, I'll just hit buy or sell. I'll have my stop losses set on here, but once I hit sell, I can adjust my stop loss after I'm in a trade. And since this is where I'm expecting price to come for an entry, I will put my target there. So yes, I'm in that trade right now, and it just hit take profit. So that trade just played out, and I entered on that trade based on the logic that this fair value gap was here. So when price was this in this area, that's where I entered. Stop loss, what was that? Yeah, I'm expecting this to be a bullish trade. I just took it here because I was expecting price to come to my entry, but I was seeing resistance in this area because of this fair value gap, and then I seen this displacement, and this displacement broke this recent low, and then price came back up, and all of these wicks is showing resistance in this area. So that was why I entered to a quick sell right here. So that right there would be considered scalping. It's a lot faster, but if you take a lot of those trades, you open yourself up to more risk. So this right here would actually be the trade that I would want for the day, is this buy. I would have had a limit order placed right here and stop loss here, and then take profit would be here. I just bought it at market because I didn't have my limit placed here. But as you see, price came down and respected this area. So that's where my buy limit was supposed to be. But I just hit the buy order when price was in this area. So it just put me in close proximity to where I wanted to get in at, and then put my stop loss in the same area that I would if I executed where I wanted to get in at. And then move my limit to up here, which is 3 to 1 of that of my risk, and that would be my 10 o'clock to 11 o'clock trade. So whatever happens on this, I would leave it alone. And if price gets above this high, what I would do is trail my stop loss up to here. I will grab it and move it up into profit. So that way now I will be considered in a risk-free trade. I'm doing it now. It's not safe to do it because that high haven't been broken, and there's fair value gaps right here. Let me get this out the way. So there's fair value gaps right here. So price can come back down and retrace into one of these, and also it can come down and tap this bullish order block right here. So I wouldn't move my stop loss just yet until this was broken. So that's that long right now. And this is just a demo. I just use this to get my subconscious used to seeing these kind of numbers. I started this account with 100,000. I've been working on it for I think almost about 2 months now, just using ridiculous risk, but using the same logic that I would use on my trade day for day. So using the same logic, there's a lot of risk, and I'm just running it up to see what I can get it up to. I use that account to scratch my trading itch when I'm not trading my live accounts. So now that we have the break above here, I will feel comfortable with moving my stop loss up there. This order block right here should act as support. So price shouldn't come all the way back down here before hitting the target. So I feel comfortable with this. If it do come down there, that's still a W. That's still a win. I wouldn't try to get in and take another trade and get more because it didn't go all the way to my target. I will be content with this and just, wait until the next day to execute. Right now, I can close the chart, walk away from the computer, and one or two things are going to happen. Either it will hit my target and it'll cancel all orders, or it'll come down and hit this limit and it'll cancel all orders. So either way, it'll stop me out in profit from this point here. Yes, it is, and it takes time to get it. Like I've been studying this for almost 4 years now, so it took me some time to get to where I'm at now, and for these terms to make sense to me, basically for me to understand them. So I definitely wouldn't expect you to understand exactly what it is that I'm saying now, but this is the language that it was used to teach it to me. So it's the language that I understand. So it's the language that I teach in and talk in. But yeah, definitely point you in the right direction and give you the videos for the source of this information so you can start absorbing it yourself and get familiar with the terminology. And that way, once we get on these sessions, you'll have a better understanding of it. The orders. Okay. Yes. 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 Exactly. Yeah. Tomorrow I'll trade the Top Step account. Also for like an entry, some information for both of you guys that you could check out. It's a lot of information to absorb, so take your time with it. But a good starting point that breaks all of the markets down from like uh 1, 2, 3 ABC type point of view is babypips.com. You go to that website. And yes, baby pips, PIPS, yes, babypips.com. I would I would start there, and that will give an explanation of like how these markets operate. It will help you with the terminology and explain candlestick formations, bullish trend, bearish trend. Like it goes over all of the like the beginning stages of it. So this here, what I'm showing you is an actual strategy of what I use to execute a trade. But baby pips will teach you what the markets are. Okay. Okay. Yeah, that's yes. That's the trading time. Perfect. All right, it's nice meeting you, Juan. All right. All right. Perfect. All right. Cool. All right. You too. Bye. Well, that limit order got hit. I, yeah, I just hurt myself. That's weird.